Hello, everybody. My name is Bennett Tchaikovsky, the accounting professor. We're going to talk today about the statement of cash flows. I was inspired to actually make this series of videos. I do have these up there someplace, but I did this crazy video yesterday that I think is about an hour long. And as I was kind of doing it, I kind of said, well, we need to go through and revisit this. So let's go ahead and do it. So my disclaimer and copyright notice, my disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2023 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So let's talk about the overview of this. Why is this such an important statement for investors? And it's because the statement of cash flows is going to show us how we go through and, basically how do we go through and use our cash in terms of did our cash increase because we issued a lot of stock? Did our cash decrease because we repurchased our own shares? Do we generate a lot of cash from our operations? Did we make investments in ourselves? Did we buy intellectual property? Did we buy a business? Did we buy buildings? And it's an extremely important statement for us because it's going to show us where we get our cash. And by the way, this is not cash flows for a business. If you showed a CEO a statement of cash flows, they would kind of go, dude, what are you doing? I don't want to know this. I want to know the future. This is the past. Remember, in financial accounting, we're focused on the past. What's really important, though, too, is what this statement is going to show us is the amount of malarkey that goes into financial statements. It's not a lot, but it can kind of give us an idea as to what we're doing here. And to give you a really good illustration of this, we're going to go to X or Twitter, or the old Twitter. Just give me a moment. So I'm over here on Twitter, and this is actually the Securities and Exchange Commission's website. This is not Twitter itself, but actually X. Let's just go ahead and take a look, though, at X. And if we go over here to Twitter and we take a look at the financial statements of Twitter, the first thing we're going to notice here is that this company, wow, they're losing $456 million in 2016, 2015, and 2014. What's important, though, to remember is this a real loss? And what I mean by that is that oftentimes in accounting, we do certain journal entries that may not really be real. The best example I can give you of these is when we go through and we are paying employees stock, right? So if I give an employee shares of stock or the option to purchase stock, in accounting, I have to make a journal entry to stock compensation expense, and I'm crediting additional paid-in capital common stock. Why is this important? Well, when I give an employee shares, I'm not really creating a liability. Rather, the employee is probably going to give me money to buy the shares. So when we look at Twitter, we see we have a loss of $456 million. But if we look at the statement of cash flows, the first thing we're going to see here is stock-based compensation expense was $615 million. If we didn't have that item, right, we would be profitable. So the reason why that for an investor that the statement of cash flows is so important is that when things are recorded like stock-based compensation expense, that's not really going to cost the company any money, are being recorded. Essentially, we can better gauge the performance of a company. So in reality, Twitter was profitable all these years. It just got buried down in stock compensation expense. You also will see companies like Meta, at least they were doing this last year, where they were showing the amount of stock compensation that was included in expense, because it's not a real number. Sorry to say it, it should be a disclosure, but I don't think it has any reason to be on the income statement. Now, as an audit committee chairman, and I serve on boards, and I have in the past, I would always include it. But my personal thought is that I would get rid of it, because it's really not a true expense. I view a true expense as something we're paying cash for. We're going to have to settle in cash. So the whole purpose of the statement of cash flows is that, kind of going back down to where we are, is that it's really going to help us find out what items are being thrown on the financial statement that really may not have a bearing on cash. And it also helps us go through and reconciles the other financial statements. And this is why we go through and prepare everything. So this is why it's important for investors. Now, some other thoughts about studying this is that when you give a final in financial accounting, it's probably the best exam you could give. And it's because it kind of ties in everything that you're going to want to go through and test on. So for me, my final exam, I have at least 2 cash flow questions. For my classes in financial accounting, when I teach intermediate accounting, it's actually also is on the final, but it's also in the first part and a little bit of a smaller version. I see McGraw-Hill, they used to do this in their 7th edition. They would start talking about the statement of cash flows on the first chapter or 2. It's like, oh, why are you doing that? Okay, you don't need to go through and do that. It's for the very ending. So the way we're going to kind of go through and learn this is we're going to start small, and then we're going to gradually go big. So we're going to start with smaller, easier questions, and then we're going to go to the larger questions. Also, we're going to be using T accounts. So T accounts, and you'll understand why I use T accounts. Very, very important. We're going to be using T accounts throughout all of our examples. Also, in terms of the direct versus the indirect method. So the only difference between preparing a cash flow using the indirect versus the direct is in the operating section. And we don't really, for lower division financial accounting, we don't really care, because we're going to be using the indirect method. If a company is using the direct method, the indirect method is required to be disclosed. Now, the AICPA has kind of come out and said that no more direct method. We're not going to test it on the CPA exam. So if you have an instructor who is making you learn the direct method, ask them if the AICPA is still putting it on the CPA exam. Hopefully you'll get out of it. But if you want to learn, if you want to see me get frustrated with a question, I've got plenty of them in doing the direct method. So, but why is cash so important for us, right? Why is this statement so important? It is the lifeblood of business. If we go through and we look at a company like Rivian, and if I come over here to Rivian Automotive, and let's go ahead and take a look at their most recent quarterly report. So they've got roughly right now about, between these two amounts, about $9 billion of cash. But right now, though, they are losing, like on their cars, they're basically losing $1.4 billion before a vehicle is even sold. They're selling cars right now at a loss. And this is very common for emerging technologies. But as we go through and look at this, right, what's really important to remember is that, well, the cash flows for Rivian, if we come over here, and this is for the 9 months ended 2023, they use basically 3.7 billion of cash during these 9 months. And they also obviously they had investing activities, and then coming down over here, they've gone through and they're going through their cash pretty quickly. But again, it's because they're more of a startup company. I'm not saying that they're going to go out of business, but the statement of cash flows can kind of go through and show us that they have to be going through and raising money, right? They issued convertible notes at 1.4 billion in order to stay afloat. right? So this is why the statement of cash flows is extremely important, basically, for investors. And when you're doing this, and one of the things I started out with at the very beginning, you would never want to show a statement like this to a CEO. And you can, but they're going to probably look at this thing, unless they're a CPA, they're going to be going, what is this stuff? The CEO is not going to want to see things in the past. They're going to want to see, how much money do I need over the next 12 months, over the next 2 years? What's my 5-year plan, right? How much money am I going to need to achieve our organization's business goals? So the statement of cash flows, this is really more for us as accountants to really kind of see, like, to give that information to the investors, is our funding coming from operations, investing activities, financing activities, or the like? So talking about these different areas, I'm going to get a little bit more into that in the next video, and as we go through and do some more examples. But let's kind of go back over here and just kind of see this over here. So again, this is going to be internal use. You'd be using a more forward-looking cash flow. And again, this is cash is something that is very, very important for us. Now, as we go through and do this, companies evolve over time. And to show you some examples of this, I want to take us back to Amazon.com, which these are all available at sec.gov. When I look at Amazon, they had in 1999, this is in thousands, a $719 million loss. So you see these things over here. Basically, it was really 320 once you added back some different things. And then they had basically cash used, changes in net of effects from acquisitions. They basically made some acquisitions over here. And then you see, sorry, these are still in the operating section. So you had operating activities, investing activities. They bought and sold stock. They purchased fixed assets, acquired businesses. And what's really interesting here is that they issued about 1.2 billion of long-term debt. The reason why Jeff Bezos is so successful is that Amazon only did one IPO. They made issuances of stock to their employees over time, but after their initial IPO, they did everything through debt financing. And when we focus over here, so now you're kind of seeing, well, Amazon used about 90 million and they're operating and they're generating, or by raising money, they generated 1.1 billion. If I look at Amazon today, Amazon is very profitable. Actually, well, they were at a loss right over here because they had to do a little bit of an investment write-off. But if we go through and look over here, they're generating cash from operating activities of 46 billion, right? That's billion, right? And as you look at this is what they used in their investing. They bought 63 billion of property and equipment, sold some stock, sales and maturities of stock. And then over here, they issued short-term debt of 41 billion. They repaid short-term debt of 37 billion. They issued long-term debt of 21 billion. So over here, as opposed to before, they've got about 9.7 billion in cash by issuing stock or bond, actually not by issuing debt net. But here they're generating about 46 billion of cash from their operating activities, as opposed to using 90 million back in 1999. Let's now take a look over here at our friends at Apple. Okay, and if I go back in time to 1996, this is in millions. They generated 519 million of cash from operating. Over here, they borrowed money of 646 million. So as you can kind of go through and see, just again, this is when Apple, I don't want to say it was at its infancy, it was definitely a very mature company, but again, things change over time. If we now look at the year ended September 30th, 2023, They're generating 110 billion in cash from their operating activities. Use basically generated 3.7 billion from investing, and they used about 108 billion from their financing. Now, why was this? They bought back their own shares, they paid dividends. So again, now that Apple is way more mature as a company, you're really seeing that most of their cash is coming in from their operating activities. So again, cash flows are always going to be different for different types of companies, but it can really go through and help us better understand in terms of what goes on with companies. So how are we going to learn how to do the statement of cash flows? The first thing we're going to go through and do is we're going to set up the skeleton. And we're going to do this for the next video, but we're going to set up the skeleton. We're going to create T accounts for all of our balance sheet accounts. We're going to deal with the additional information first, and I'll show you how that looks. We're going to reconcile all T accounts so that they balance. We're going to check to see if the big cash T account is balanced. And then we are going to prepare the financial statements, or basically prepare the statement of cash flows. So that's how we're going to go through and do it for this series of videos. Every single time we get a cash flow question, this is how we're going to be going through and learning how to go through and do it. So I want to thank you all for watching and for liking and subscribing. If you have questions or if you want to see a video on any particular topic, absolutely send me a message. If it's something that it's feasible that I can do, I will absolutely go through and do it. If you have questions, please feel free to email at 1812cpa@gmail.com. I have a lot of different emails that are out there. Most of them get to me. And have a great rest of your day. And I look forward to seeing you on the next video.